Welcome, my name is Geoff Driver, General Manager of Business Development and Investor Relations for AMCIL Limited. I have with me today Mark Freeman, who's the Managing Director and Chief Executive Officer, and Kieran Kennedy, who's the Portfolio Manager who's responsible for AMCIL within the team. So Mark, we just announced our result to the 31st December 2021. A couple of key features within that was the increase in profit and also the announcement of a interim dividend. Mark, do you want to talk about the increase in income for the period and also the reasoning behind the declaration of an interim dividend for AMCIL?
Okay, thanks, Geoff. Well, obviously, the last couple of years in the market in terms of income have been impacted by COVID. Obviously, a number of companies had reduced or in some cases cut their dividend. And we've been in a period now where those essentially being reinstated. So that sort of drove an increase in income for the markets overall and into our portfolio. In terms of the dividend we pay out, as announced previously, we used to have a policy of paying out all our franking credits at year end only. And we sort of suggested that, well, we stated that we were no longer going to do that. We wanted a more balance between dividend and retaining capital in the fund. But I guess as part of that, we felt that's giving us a bit more flexibility around how we pay dividends and when we pay dividends. And I guess some of the feedback we'd had from shareholders was around seeking a bit more of a balance between, rather than paying a dividend once a year, could we look at an interim and a final? And so I think this flexibility we had now enabled us to pay a 1 cent dividend as an interim, and then obviously we'll look to hopefully pay an appropriate dividend at the end of year as well, so to give us that better balance.
Thanks, Mark. So Kieran, the portfolio performed quite well against the market over the 6 and 12-month period. Have you got some comments about what drove that outperformance and particularly the key stocks within the portfolio that drove that performance?
Yes, thanks, Geoff. So I guess firstly, we feel the volatility of the last few years has really served us well to have a long-term approach through that. It's been a very unpredictable time, but our ability to take a medium to long-term view of the best opportunities in the market has really taken away the difficulty of having a view on some of the really challenging issues we've seen through this COVID period. So through the 6-month period, our portfolio was up 10.4%, including the benefits of franking, versus 4.6% for the ASX 200 on the same basis. It's clearly quite strong performance, and the strongest contributors to it were some of our large holdings, companies like Mainfreight, Macquarie Group, Macquarie Telecom, Sydney Airport, which obviously had a takeover bid through the period, Goodman Group, ARB, and James Hardie. The other interesting feature of this period is we had an unusually small number of detractors from the performance. It was very consistent performance across the portfolio. A couple of stocks like BHP, which is always volatile, and Westpac, which has had some issues, which I'll touch on shortly. They were the only real notable detractors through the period. So pleasingly, over a 12-month period to 31st of December, the portfolio was up 22.6%, including the benefits of franking, versus 18.7% for the ASX 200.
So you touched on Westpac. Kieran, what were the sort of major changes you made through the period, the 6-month period?
Yeah, thanks, Geoff. So I guess the thinking we've been exercising our mind through this period is we felt that valuations were getting up there. We were starting to anticipate the rate rises that we're seeing coming through in January. We felt that, I guess, central banks around the world were probably leaving interest rates too low for too long, just to make sure we were getting the necessary takeoff really out of the challenged period of COVID. So with that in mind, we, again, taking medium to long-term view, we looked at stocks like NextDC and Seek and just felt they were fairly fully valued and vulnerable and risky for the portfolio. So we exited both of those. And we also reduced positions such as ARB, Macquarie Telecom, Objective, Xero, all great companies, but we just felt we're really getting to a level where the share prices were impacting the sort of return you could expect over the next 5 years. Excitingly, really, we got the opportunity to initiate some positions in some really good companies. Net Wealth and Domino's Pizzas are two of the companies that we think have the most backable sort of 5 to 10 year runways in front of them. They generate excellent return on capital, and they have really passionate owner-driver management teams, which is just another feature that we're always on the hunt for. So they're businesses that we felt we'd love to have in the portfolio for a period of time, and volatility, and in both cases, those stocks were well off their highs, saw us able to put those into the portfolio. We also saw some opportunities in some emerging companies. Just a reminder, it's a feature of AMCIL that we like to have the breadth of company size, from the largest right through to those really interesting up-and-comers that we think we can identify. Through the period, we bought Lark distillery business in Tasmania. We see there that there's a growing reputation for Tasmanian premium whiskey building around the world, and Lark seems to be emerging from that pack to be the company best placed to take that onto the global stage. So we'll watch that with interest. And Beamtree was another, which is probably not very well known at all, but we just see an interesting little company emerging there with a good offering around healthcare data, which we think's got some really good prospects going forward. Just coming to the banks, we did mention Westpac. So through the period, we switched our NAB holding across to Westpac. To be honest, we probably did that a bit too early, given share price movements since. But really, the view is we're taking a 5-year view on relative value here, and we think Westpac's now at a level, it's been sold down to a level where it really has some good prospects ahead. Importantly, if they can get on top of their issues, there's a lot of work for that company to do, but we think the rewards will be there in the share price relative to the other banks if they can get on and do that.
Thanks, Kieran. So the calendar year has started off with a fairly volatile market in January. Mark, perhaps you could give us some comments about the sort of general outlook, what you see sort of over the next, say, 6 months, and Kieran can relate that particularly back to the AMCIL portfolio. And I guess secondly, as part of that question, the reasoning behind announcing a share purchase plan with the interim result.
Yeah, well, look, just starting with the share purchase plan, I mean, for all the reasons Kieran just pointed out, just sort of, in the space of a month, we've gone from a period where we were very concerned about valuations on the type of stocks we want to be in. And I said that's normal part of the course. I mean, we talk about our primary objective is really invest in companies rather than share prices. And as long as our companies that we like still have a good outlook, then we're always looking to, we've got a preference to adding to those holdings. And as I said, in the space of a month, we've gone from being very cautious to now saying, well, actually, there's some interesting opportunities starting to arise. So in that environment, we've sort of taken a view that a share purchase plan is a good time because we are starting to see some interesting opportunities to allocate capital into high quality companies at more sensible prices. So that's the simple analysis there. And then just more broadly on markets, and as we've been saying, the rising interest rates has been a catalyst for this adjustment. Look, whether it's got more to play out potentially, I mean, cycles don't tend to stop in the middle. They tend to go from one extreme to the other. So, it wouldn't surprise us to see more weakness, but at the same time, trying to predict markets is something we don't do. It's very hard to forecast where markets are going, but it's fair to say the adjustment so far, we think it's actually been healthy. So it'd be good to have a bit of extra capital from here if we get further opportunities. And obviously we go into reporting season soon, and that's really the important stuff to us, is to try and understand how our company's performing in the business world rather than looking at a share price.
And Kieran, have you got any sort of other follow-up comments to that? Or?
Yes, thanks, Geoff. I mean, I guess the markets have been very buoyant from the lows of March 2020, and I guess any market environment throws up challenges, and particularly to the sort of latter part of last calendar year, the challenge we were facing was really to find good long-term value and really fair value. They're rarely cheap, but in the really high quality companies that we want to add to for this portfolio.
Mark and Kieran, thank you for your time.